Here's a summary of the Coca-Cola Company's Q2 2026 earnings call, designed for clear, spoken delivery. Good morning, everyone. We've just concluded the Coca-Cola Company's second quarter 2026 earnings results conference call. The call featured insights from CEO Henrique Braun and CFO John Murphy. Overall performance and financial highlights. The company reported a strong first half of 2026, demonstrating broad-based momentum. Revenue. Organic revenue grew at the high end of their long-term growth algorithm, with Q2 seeing 6% organic revenue growth. On a two-year average, volume growth was 2%, showing balanced top-line contribution. Profitability. Comparable gross margin increased approximately 120 basis points, and comparable operating margin increased approximately 90 basis points in Q2, driven by underlying expansion and currency tailwinds. Q2 comparable earnings per share, EPS, reached 97 cents, an 11% increase. Volume. Unit case volume grew 5% in the quarter, aided by cycling an easier prior year comparison. Market share. Coca-Cola gained value share across most of its business. CEO Henrique Braun's key statements. Henrique Braun emphasized the company's confidence in its business model and its raised 2026 guidance, attributing success to three core beliefs: the strength of the beverage industry, the enduring appeal of its brands, and the unmatched strength of its global system. He highlighted execution against three key priorities. 1. Consumer centricity. The FIFA World Cup campaign was cited as a prime example of leveraging insights, innovation, intimacy, and integration. This campaign generated significant first-party data and drove strong volume growth for trademark Coca-Cola, 5%, its strongest in 17 years excluding COVID recovery, and Powerade, 8%. 2. Constructive discontent. The company is focused on driving more for more by making its brands more relevant to more consumers. The relaunch of Coca-Cola 00 for evening occasions was a key example. 3. Digital at the core. Elevating the role of digital across all operations to amplify existing strengths with greater agility and scale. Braun acknowledged an uneven global consumer environment with inflationary pressures and geopolitical uncertainty, but stressed the company's ability to adapt and earn every transaction by staying close to consumers and offering the right products at the right time. CFO John Murphy's key statements. John Murphy reinforced the strength and consistency of Coca-Cola's business model, highlighting the levers used to drive long-term growth in a dynamic environment. Guidance update. Coca-Cola now expects to deliver at the high end of its prior revenue guidance, with organic revenue growth of approximately 5%. Comparable currency-neutral EPS growth, excluding acquisitions and divestitures, is now expected to be 7% to 8%. Overall comparable EPS growth is projected at 9% to 10% versus $3 in 2025. Currency. An approximate 1-point currency tailwind to comparable net revenues and a 3-point tailwind to comparable EPS are now expected for the full year. Divestitures. Divestitures are projected to be a 2 to 3% headwind to net revenues and a 1% headwind to EPS, contingent on the closing of the Coca-Cola Beverage Africa sale. Fairlife. Production operations have largely resumed at their facilities, with minimal impact on Q2 results and no anticipated material impact in the second half of the year. The Webster facility continues to ramp up capacity. IRS tax case. Oral arguments have been presented before the 11th Circuit Court of Appeals. The company remains confident in its position and the outcome of the appeal, but the timing of a decision is unknown. Balance sheet. The company maintains a strong balance sheet with net debt leverage at 1.4x EBITDA, providing flexibility for reinvestment and capital returns. Future outlook and forecasts. Second half 2026. Momentum is expected to continue. though the company will cycle higher comparable growth figures and face 6 fewer operating days in Q4. The company is focused on balancing affordability and premiumization to meet evolving consumer needs. Long-term growth algorithm. Management reaffirmed its long-term growth algorithm of 4 to 6% for the industry, with an ambition to consistently perform at the higher end of this range. Significant risk factors: global economic uncertainty, inflationary pressures, geopolitical instability, and cautious consumer sentiment in key markets were cited as ongoing challenges. Commodity volatility. While manageable currently, continued monitoring of commodity costs is essential. IRS tax case. The ongoing dispute with the IRS presents potential financial implications, though the company is confident in a favorable outcome. Calendar shifts. The 6 fewer days in Q4 2026 compared to Q4 2025 will be a consideration for reporting. Highlights: strong broad-based volume and organic revenue growth in Q2 2026. Significant gains in value share across markets. Successful execution of the FIFA World Cup integrated marketing campaign, driving consumer engagement and data collection. Expansion of margins while continuing to invest in the business. Double-digit earnings growth. Resumption of Fairlife production and continued capacity ramp-up. Winning back the Marriott contract after 34 years, highlighting a renewed focus on consumer and customer centricity. Lowlights: profit declined in EMEA due to the phasing of investments. Comparable operating income declined in Asia Pacific, primarily due to investments aimed at expanding the consumer base across socioeconomic segments. Geopolitical conflicts continue to disrupt operations in the Asia and Middle East region. In closing, both leadership expressed strong confidence in their ability to deliver on their updated 2026 guidance and long-term financial objectives, driven by the strength of their system, their consumer-centric approach, and their commitment to innovation and digital transformation.